Hello, Serge.
Good morning.
Today,
Pretty good, pretty good.
so yeah, today's presentation will be long-short tokens, LST as a convenient and functional system for trading leveraged products. The name sounds like very interesting, and yeah, we would love to learn more about it. The stage is yours. Please start when it is convenient.
Well, thank you, everyone. Pleasure to be here. So let's quickly talk about why do we actually need the project that we're talking about, which is the long-short token. Generically, in traditional finance, market participants get leverage through two sources. One is various products that provide them leverage in a built-in form. For example, long-short ETFs, or potentially, various option products, or they're doing it through getting access to margin. So in crypto, we also have seen introduction of margin, and essentially the idea is that you are able to borrow money, do trades with those borrow funds, and then have your returns amplified by the amount of money you borrow. So for example, if for every dollar that you have in your trading account, you borrow another two, your trades would be amplified 3x. So every time you make money, you're gonna make 3 times what the money you invested, and then every time you lose money, you're gonna make 3 times the amount of money that you have invested. So why is that a good thing? Obviously, as we just described, you're making more money when the market goes up. You're losing more money when the market, when the trade goes against you. But very importantly, this allows you to much more efficiently express your views on the market. And supposedly, if you know what you're doing, you could make better returns on your capital, as long as you're making more than the funding costs. Now, the obvious drawbacks that this methodology includes is if you start losing more money than you actually invested into the system. So for example, you have leverage 1 to 100, and you go long, and the market goes down, let's say 2%, you can't lose more than the original money that you have invested. So you get a margin call, and then whatever the platform that you're using for trading is going to issue some sort of a liquidation system. Plus, whenever you borrow money for your margin trading, you're going to get charged somehow, right? Either you're going to get charged interest, or you're going to get charged additional commissions, and then eventually you're going to have to repay those things. Which creates a little bit of a problem, right? Cryptocurrency is a very volatile asset class, and there's a lot of people trading on margin. So a lot of the times this leads to significant losses, right? So sometimes you're gonna buy something with a leverage of 100, everybody else thinks the same thing, and then the asset class or the asset that you are referring to will actually decline in price, and next thing you know, everybody's getting liquidated. So What LST is trying to address is to create a way to trade with internal leverage, but without the liquidation risk. So you have two tokens. One is the long token, and the other one is a short token. When you buying or selling these, when you're buying long token, you're getting a long position that's levered. You're buying a short token, you are creating a short position. You're entering into a short position that is also levered. There's no liquidations. There's no stop losses. You have the flexibility to sell your tokens at any time. You're not forced out of these positions. And then in terms of profitability, the returns on these tokens are going to be comparable to what you're going to get in the futures or perpetual markets. So the idea is that we are taking the best of the leverage that, for example, in traditional finance would be employed by people using levered ETFs. But you're going to get the flexibility of not having to be forced to undergo the margin calls. So LST follows price periods in a decentralized exchange, and it looks at the changes in price of a token pair as it trades on a decentralized exchange, let's say Uniswap V3, and it allows users to receive tokens for each pair at some proportion to the change in price. We have chosen to do we have chosen to do daily resets. So essentially both long and short tokens will be bought and sold to the system once a day at 8 a.m. And then users pay a little bit of a commission for leverage. If by the time next day 8 a.m. comes and the price has changed, right? You're gonna, in case of a long token, you're gonna make money X times greater compared to the price increase of the token pair. In case of a short token, you're gonna lose money X times compared to the increase in the token price. And the opposite, if the token price decrease, you're gonna, as an owner of a long token, you're gonna lose money, and as an owner of a short token, you're gonna make money. How does it work internally? I mean, internally, it's essentially a system of two accounts where if the price increases, the system just balances the money in two accounts and moves money from a long token vault to a short token vault. And the opposite occurs when the underlying goes into the other direction. If, however, the size of the return is bigger than a certain cap that is built into the system, right? Obviously the amount of money can only go down to zero, and that creates a natural cap on the amount of money you could lose, but also that creates a natural floor. Creates a natural cap on the amount of money you could make, but it also creates a natural floor on the amount of money you could lose. So after the period opens, 8 a.m., before it closes, you send the deposit request to the system and you transfer the funding token, for example, USDC. They deposit into the system, and then once the deposit period ends, the request is finalized and you credit it with a long token or short token. And these long and short tokens will actually trade on a DEX as 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 any other regular ERC20 token could, making this a very, very straightforward methodology to go through. Same way, if at the beginning of the period you submitted withdrawal requests, meaning you actually own LST or SST, I'm sorry, long ST or LT, long tokens or short tokens, you submit a withdrawal request that goes to the appropriate vault, so LTV or STV, and then once the deposits or withdrawals occur, the F tokens will be returned to the users. Obviously, if that only happens if the user has sufficient funds. If users didn't have sufficient funds, they are unable to receive anything back. We actually covered the deposits already. So why is this a good thing? I mean, it is essentially an application of existing traditional finance technology, which is levered ETFs. But we introduced optionality into it, and these leverage tokens allow investors to increase return on their investment without the risk of a margin call. And emergence of these platforms will simplify trading with access to leverage without actually, the complexity of margining, the complexity of margin calls, the complexity of liquidations. So, hopefully this type of system will allow people to earn more and, reduce risks compared to what, they get on other platforms. And for people who are making markets in this, there are hedger rewards. The system ensures stable and profitable operations. So just to conclude, LST is a financial trading platform. It is underlying agnostic. It introduces a product that is an alternative to the margin trading. We are allowing users to buy and sell a token once a day and then, continuously sell it in a DEX. And that allows them to have access to financial leverage without the cost of, without the potential risks of margin calls and liquidations. Well, thank you very much. I would love to hear your thoughts, and please refer to our research paper for more details.
Well, thank you, Serge. Good presentation, we can say as usual, as it is already the second presentation of yours on this forum. So there are a couple of questions. So the first one is actually let me to simplify the message and then again return it back to the use case, because we here having not only academic industry and research and the development industry, but basically people who are actually the users of the product. So let me put it this way: if I have a correct understanding of what this research paper was about and what this product is about. So, for example, I am a day trader, right? And I see for example, the volatility of Bitcoin being around 2% every day. It is either 2% up or 2% down. And let's say I developed some strategy on how I predict whether today it will go up or today it will go down. So in usual case, I can, for example, take some money, right, and take, if I'm correct in my prediction, to get 2%, right? But if I will be using your product, right, or this methodology you suggested, I will be able, instead of 2%, I will be able to get 6% profit. Am I correct?
Correct. So essentially, instead of making, let's say, instead of making whatever return on capital that you would in unlevered form, you would return X times.
Okay, understood. So, how am I limited by the amount of funds I'm able to do this? Am I able to do this with $1,000 or I don't know, $100 or $10,000 or maybe I don't know, $20,000? So,
I mean, you are constrained by the amount of money present in the system, right? So, for example, if this particular underlying if LST for this particular underlying has, let's say, $1 million, and you're trying to go long, for example, $10 million, you are not going to be able to, right? Because you need a counterparty to take position opposite of you.
okay, I see. And do you provide the information about it? So what could be the, for example, the recommended or maximum bid on this?
Yeah, I mean, you'll be able to get you're going to be able to get this information directly from the smart contract.
Okay, got it. So okay, so let's say today I'm able to put $10,000, right? And I have some prediction models, like which says that it will go up 2%. So I am I'm buying the token, right? And I'm able, instead of $200, which is 2% of $10,000, I'm able to get $600 as a profit, right?
Yep.
This is the case.
Correct.
Okay, understood. Okay, got it. And if let's say, okay, I have my very good prediction models, and they, for example, 90% of the time they are correct. But let's say my model predicted that it will go up, and I bought the tokens, and then to the opposite, it went down. So if I'm dealing with Bitcoin, it doesn't really mean nothing for me, because I just know that I bought it, right. I'm not able to resell it at profit today, but I know that I can wait, for example, for 1 month or I don't know 1 year, etc., until the price will start going up, and then I will able to get my profits. So basically, in that sense, it is not lost money. This is like a frozen money. Does it work the same with your system?
Yeah, I mean, essentially, you're going to be able to hold, long token or short token for as long as you want, for as long as you have enough money times the leverage to withstand the losses, right? So if you buy long token, Bitcoin goes with the leverage of, let's say, 3x, Bitcoin goes down 1%, then it goes down at 1% again, goes down 1% again, you just lost 3%. I'm sorry, you just lost 3% on Bitcoin, and the leverage is 3x, so you lost 9%.
Yeah.
Right. If after that Bitcoin goes up, let's say 20%, you're going to make the difference between whatever you lost and whatever the levered return.
So if let's
For
say,
example, in one day Bitcoin goes up 20%, you're going to make, so you lost 9% in the previous 3 days.
Okay.
And then next day it goes up 20%. You're going to make 3x times 20, so that's going to be 60% minus the minus 6%. So whatever.
Yeah, got it. Minus 9, so 60, the 51%.
Yep.
Okay, I got it. Yeah, well, very interesting product. We will probably, basically, yeah. Thank you so much. We will be learning more. Okay, does anyone else have any other questions? Okay, Serge, I think there are no more questions. Thank you so much for the good presentation today. And
Well, thanks a lot, and feel free to reach out directly.
thank you. Yeah, have a great day.
You too.
Thank you.
Bye bye.
Bye-bye.